Well, thanks, Ken. I also want to extend a welcome to not only all of you, but to Lynch and Nick Stratigos, who's joining us here tonight. We've invited Nick to pinch hit for Hugh McManus, who's somewhere whirling around the slopes in Switzerland. And so Nick, as winner of the most recently completed groundhog contest, thought we'd engage him and have a guest tonight to go with our guest damsels. And we really do like the practice of having guest stock selectors, as my teammates on the round table will suggest that they might like somebody to do some picking besides me based on recent track records. And you know, I just want to point out that Research in Motion is now on sale for lower than book value, so there's a real good opportunity there for some company like, oh, I don't know, Microsoft with a bunch of cash to come in there and bail me out, but I wouldn't hold my breath. Anyhow, welcome everybody. Again, if you're new to this, we'll get into what we go over on a monthly basis here. But first, we have to start with the slide to make the legal beagles happy. Again, no investment recommendation is intended by anything that we do here tonight. We do a lot of demonstration type things, and everything is done for educational and illustrative purposes only. And we generally try to disclose when we happen to own a stock that we're talking about. And since we do talk about many community favorites and many stocks within our own portfolio, you should assume that we could be talking about stocks that we actually own. I'll kind of kick things off with a quick introduction. Again, if you're new to the round table, this is the type of standing agenda that we have every month. Again, welcome. We'll take a brief look at how we've done results-wise. And then I do want to share as tonight's moment, the heavy hogs. That's our code word for, it's actually a portfolio of the most frequently selected stocks in this year's, the 2012 stock picking contest at Manifest Investing, known as the Groundhog. So there could be some ideas there. Pretty good track record over the years. And then we'll just go into some general discussion, make our 4 stock selections. If we have any time left over, we are happy to engage in Q&A, and certainly our ears are always perked up listening for good ideas for stock studies. Here's just a quick reminder of what we are here to do. It is for a lot of fun and education, but we are serious. We'd like to come up with a collection of stocks that outperform the general stock market by 5 percentage points over the long term. We're not keeping up with that very well yet, but our hopes reign supreme. Also on the accuracy side, we'd like to see about 2 out of every 3 selections actually beat the market from the time that we pick them. So we'd like to see roughly 65% of our selections outperform the market while held within the tracking portfolio. Here's a quick look at how we're doing so far, and you can see that those of you that have been around for quite a while actually see that as good news. Those of you that are new would say, whoa, these guys are slumping a little bit. Our actual relative return, this is for all the selections made since July 2009 in aggregate, is about -3, -3.5%. And again, our target there is to get somewhere in the neighborhood of +5%. And as my colleagues would probably point out, you take some of my more stellar selections out, and that performance deficit goes away in a hurry. So that hurts. On the accuracy side of things, and again, accuracy is simply a stock that outperforms the Wilshire 5000 while we track it. 40% of our selections have done that. That's down a little bit from last month, and again, we're shooting for something in that 60 to 70% range. Here's just a quick look at the market that we're dealing with, and the market has been red hot for the last 2 months, actually maybe a little bit longer than 2 months. As you can see by that surge on the right-hand side of the green area is the Wilshire 5000 as measured by the VTSMX Total Stock Market Index Fund. It's a mutual fund. And the gold bars are the average or the median value line low total return forecast. So again, the real shopping opportunities were there back in the depths of the that Great Depression that we had, or Great Recession that we had. And again, we're reaching that point where it's a little bit tougher to find attractive stocks. The median forecast right now is approximately 9%. If you look at Manifest Investing, our median projected return is about 7%. So again, we're in upper single digits return forecasts for the average stock, just to give us kind of a lay of the land type reading. All right, just one last quick summary. I just want to point out for people that may be new to this, again, using the techniques of the modern investment club movement and the stuff that we've been taught, we basically build or envision models of companies and come up with a 5-year forecast for the companies that we study. That's the projected annual return. And then we balance that off with a second major characteristic known as the quality, and those are the 4 components of the quality rating at Manifest. So we're basically always trying to shop amongst the best companies within industries and sectors, and basically shopping for them when they're on sale. All right, so here's, I just thought we'd kind of kick the floor open for this one. Nick, you may have some comments about this as our reigning champion. This is the heavy Hogs portfolio for 2012. And the floor is basically open to any of you guys. Do you see any favorites or anything that you'd like to point out about any of the stocks on the board there?
Well, I see about 4/5 of my portfolio on that list. So that's either a good thing or a bad thing. So that means I have all the chance in the world, or no chance at all of repeating.
So you're in the consensus fold, huh? Either that, or people waited till you made your selections and then they made theirs.
Maybe.
Yeah, Mark, we run a contest in mid-Michigan called Stock Pickers, and it begins on November 1st of each year. So going back to November 1st and up to this date, about 4 months ago, the best performing stock in our stock contest right now is Mercado Libre, and that's number 1, 2, 3, 4, 5, 6 on this list right here. So it's been on a tear for the last 4 months and still carrying a par that's in the yellow. So that's a very interesting stock to take a look at, I think.
That's one that was in my portfolio from last year, too, that helped me get to the top.
Mm-hmm. Yeah. Yeah, I see several of my roundtable picks on there. I think I own about 5 of them as well.
I own about 7 of them myself.
Yeah.
Wow.
And it'll be a little more relevant when we get to my pick, but the top one in par there, Baidu, is interesting. The Chinese rule.
So we're
Chinese internet rules.
We're going back into the Chinese quagmire again, huh?
I just did my quick count, and between my IRA, Natalie's IRA, and our personal portfolio, I own 10 of these stocks in those 3 portfolios.
Oh, wow.
So that's one of them we're kind of looking to pare back right now. The Buffalo Wild Wings, if you've been eating that food for a while, as far as the stock's concerned, you've made a lot of money, and you might want to kind of check out to see how big a piece of the portfolio it's become. Same thing's true about Coach in the last year or so.
Yes, Coach has done quite well.
Well, one of the reasons that we share things like this is, as Ken was mentioning, that contest that he's run up at the Mid-Michigan chapter for years, he does a thing where they build a portfolio of the most frequently chosen stocks. And I believe you're on, what, 7 or 8 years of continuous outperforming?
This is the 7th year of the contest, and the first year, Mark, that it's the choice portfolio is seriously behind the benchmark right now. Now, there's still a long time to go in the contest, but this is the first time in 7 years that portfolio is lagging a little bit. A lot of it has to do with the fact that both Cognizant and Infosys made the portfolio, and they both have been underperforming the last 3 or 4 months.
Yeah, they have been a little bit sluggish. Well, maybe we jinxed it a little bit, but again, the concept is, you know, this is basically a bunch of people, some of them swinging for the fences a little bit, but in general, a group of now about 80 participants in this year's Groundhog contest, and the favorite stocks they have chosen. So you're basically looking at a group of very like-minded investors trying to pick a stock that is well positioned not only for the next year or two, but probably over the next 5 years. in their opinion, and this is the consensus, and there's some pretty strong consensus on there. So interesting, and again, I do want to make the point that this presentation will be available in the Manifest Forum and in a couple of different places after the session. And you can get to this actual portfolio using that's a completely public link at the bottom of the page there. It's a public dashboard which will display the status of this at any time during the next year. Ken, why don't you go ahead and take this one? This is the tracking portfolio report card for the roundtable selections that we've made so far. Did we lose Ken?
Yeah, I'm talking into a muted microphone. It's telling us some pretty decent things here. The portfolio averages, you'd like to benchmark those, and the fact that the par is green is telling us that the potential return for this portfolio we're putting together is 5 to 10 points above the market average where it sits tonight. So that's an A value, a great grade to receive. And we'd like to see quality for the overall portfolio stay in the excellent category, in the A category, if you will. And that means that we'd like it to be above 65, and it's at 75. That's great. I was going to talk when I got to my section, and I can bring it up right now, that you like the growth of your portfolio to be somewhere in the 11 to 12.5, 13% range. And I thought the growth in our total portfolio it wasn't bad, but I thought we maybe would like to boost it just a touch. So, I might give an A- to that growth number right now. It's not terrible, but I would much rather see that number somewhere closer to 12 when I was dealing with things. PE ratio, there's not a real benchmark for the PE ratio, but I don't want that PE ratio to get too far away from where the market's PE ratio is. And depending on what guidelines you use, what standards you set, the PE ratio for the market right now is somewhere around 14 or 15. And again, that's variable depending on how you choose to represent the market. I tend to ignore yield in a growth portfolio and treat it as just icing on the cake, so I don't give the yield a grade, but I do look very closely at financial strength. I want good, strong balance sheets. To me, 80 or above is where I'm looking, and so this 84 is definitely an A. And you know me from mid-Michigan, up, straight, and parallel, and this EPS stability is talking all about straight. So I'd love to see 80 or better, and I'll take that 79 and give the overall portfolio an A. I also like to see my size. This isn't a bad size picture. Not a bad size picture at all. It's a little bit heavy on the faster growing stocks than on the mid-size growing stocks. This is not based on the definition that you might find in some of the SSG books. This goes back to a definition from George Nicholson. It's about 30 years old, where he says that if you grow slower than 7%, then he'll classify you as a slow grower or as a large company. And if you grow faster than 12%, he'll classify you as a fast grower. That's usually a small company. And if you grow in between 7 and 12%, he'll classify you as a mid-sized grower. So we're there. He'd like to see 50% mid-size, 25% fast, 25% slow. So I think that's a pretty decent picture. We're a little bit tech-heavy, maybe a little bit healthcare-heavy, but I just don't pay that much attention to sector diversification unless one of those sectors starts to gobble up, 60 or 70% of the pie. Then it might mean that you have to really take a look at the kinds of stocks and what they represent, what their business models are. But I might tend to stay away from tech and healthcare, and then in about 15 minutes I'll show you that I won't even pay attention to that by the choice I'm going to make. So it's there for you to look at, for you to be aware of, but We don't find very much written in Nicholson's works about sector diversification, which says, to me at least, that he didn't regard it as anything extremely important. Does that clear up this screen a little bit for you, Mark?
Absolutely. Thank you very much. Yeah, and certainly not something to emphasize. I think our lessons over the last several years have taught us making sure that you have the right blend of fast and slow and medium type companies is probably more important. Well, here are the companies that actually make up the portfolio. Now, I've truncated here a little bit. I've just listed the largest holdings in the club. In fact, the one at the very bottom there, that was brought up just a couple of months ago by Ken. MWI Veterinary Supply, that $1,000 invested in that just a couple months ago is all the way up to $1,367 already. So that obviously is the type of thing we like to see. But what all of these positions represent are $1,000 investments made into roundtable selections since July of 2009, and some of them are multiple time selections. Like I believe, well, I'm sure of it, Cisco Systems at the top is a 5-time selection, so there's $5,000 invested, now worth approximately $5,400, and that's just what the portfolio looks like from top to bottom. And again, you can look this over at any time. Jumping to the public dashboards from the Manifest homepage. Also dredged up this short list of the type of stocks that would probably attract our attention if any of the four of us were thinking about accumulating an existing holding. And what we've done here is sorted by projected annual return descending, so it's going from top to bottom. Oracle is the highest return forecast down to Massimo. All of them are in the sweet spot that are color-coded in green on the right, and many of us here would probably shop right in the center of that page for the companies in that area if they were not. We might avoid a Walgreen, for example, because that's getting to be one of the larger positions in the portfolio. But again, this is just an area where it might be some decent shopping opportunities. Any comments or questions at this point, Ken?
Yeah, Mark, I can reinforce the fact that I just made in the last slide by looking at this slide. When I went out searching for a stock to add to the roundtable portfolio today, this is the first thing I brought up. And again, you can find this on the public side. Right on the opening page of Manifest Investing, there's a list of different portfolios. And if you click on the Find More or Others, you get a longer list, and right on that list it says roundtable stocks. So you click there and you get this exact dashboard. But I knew from looking at the dashboard statistics, the report card, that I would like to see a little bit more growth. So I focused in that growth column to start with, and I kind of just eyeballed it and looked for those that were growing the fastest. I saw Cognizant, I saw BRLI, I saw Quality Systems, Apple, all growing at 15% or more. I kind of took a look at how much of the portfolio those fast growers already occupied. I noticed Cognizant and BRLI were both at 5+, and then I got down to Quality Systems at only 1.7, and I stopped my search for a stock to add. It's sitting in a great par going forward, 5 to 10 points above the sweet spot. It has good growth that's going to help nudge that growth value for the entire portfolio a little bit higher. And I'd love to see us, raise the proportion to 2.5–3% by adding another $1,000 to this position.
And I'll jump off Ken's remarks too. I also normally start my look for stocks on this list. In the past few months have found my pick here. This month I decided to consider jumping into a new stock, but I started my screen by taking a look at two of the stocks that I would consider adding to the portfolio if I had just accumulated, and those two were Oracle and Cognizant. You see those two being at the top, and you can include portfolio recovery in this analysis as well if you like, and just basically said, okay, I see the Oracle's the lowest quality at 84, and the lowest return is Cognizant at 20. So I did a stock screen, and you'll see this when we get to my slides. I did a stock screen with those as my parameters, and figuring let's see what's out there that is at least as good, if not better, on those two criteria. So
ooh, I like that.
I use that screen too.
Very nice.
And Cy, you know, you're absolutely right. I just skipped over portfolio recovery, just flat out missed it. So it definitely would have been one of the ones I would have considered, and in fact, it might have been my choice if I wouldn't have just flat out missed it. But there I am down at Quality Systems, and I'm very happy with that choice of Quality Systems, by the way.
Or you could have called me and asked me which of the two I liked the best and then gone with the other one.
Well, that does work a lot, Mark, but
turn right, turn left, I don't know. Anyhow, that's a decent place to go shopping. I would like to point out that Hawkins is doing pretty well there, down towards the bottom of that list. So not every one of my picks has a creative adventure ahead of it.
You know, I used to bowl on a regular basis, Mark, and every 8 or 10 months I'd get a strike, and then the whole rest of the team would say, you know, even a blind squirrel finds a nut sometimes, you know.
Oh, man. I used that line on the Fighting Illini basketball team yesterday. They managed to finally win one. All right. Well, let's go ahead and jump to the next part of the program and invite Cy to describe an interesting little company, NetEase. Take it away, sir.
All right, I will do that. NetEase is my pick. Tonight we'll look a little closer at what it does as we move into it, but it is a Chinese internet company. I'm sorry I don't have a clever presentation like Ken did for our last Chinese pick, John Penn.
I hope you have better results.
I do as well. In fact, I had to fight some real China phobia to go with this one. But you can see it certainly fits our criteria of up, straight, and parallel with very strong historical returns or historical growth in sales and increase in earnings per share, and pretty good forecasts going forward the next couple of years. But I guess I could say, since I decided to get a little more daring and a little bit out of my comfort zone with NetEase, I was born in Louisville, Kentucky, home of the Kentucky Derby. And so maybe this is my horse racing pick, a little bit of a gamble. But actually, I think that the sorts of things to kind of bounce it off the Jean Penn and the other, Chinese contagion companies that I think many are struggling. And if you think back even on Jean Penn to our slide before, I think we're at least back even, just not on a relative basis with some of the. Well, no, I'm sorry. I guess there's 3 picks there. I noticed it was 2000, but in comparing. This was Jean Penn. Jean Penn's covered by about 5 analysts. NetEase is covered by 26 or 27, depending on who you look at. NetEase also is covered by Morningstar, although it is not in the Value Line Standard edition. Their auditors is PricewaterhouseCoopers, or the Chinese affiliate of PricewaterhouseCoopers. So all of that gave me some level of comfort that perhaps this is a legitimate Chinese company. And when I told Mark that, he told me that legitimate Chinese companies were not allowed. But we're going with it anyway. Moving on with the slides, as I mentioned earlier, I started the pick for NetEase by doing a screen based on Oracle and Cognizant's power and quality. Here are the results. The top results, notice that NetEase is the top, and actually you've got a number, I guess the top 4 are all Oriental companies, the top 3 being Oriental Internet companies. So I said, let's take a look at NetEase, and because I wasn't familiar with the company at all.
You're a brave man, brave man.
Let's move on to the next slide. I did a quick little industry study by clicking on the technology internet link on the on the screening results actually. And NetEase, you notice, is the top quality company there with Baidu and Ctrip right behind it. All right, next slide. And I just wanted to also take a look at the current value, see how it compares to historical standards. This is the chronicle for NetEase, and as you can see, the par, which is the red line, is about as high as running at around 30%, which is about as high as it has been in the last 3-4 years. And you can also notice the relative return, which is that pink solid area that is also at all-time high. And one last thing that I will point out that I always like to see on Chronicles is when I see the par jump up, as you can see it did back in late 2011. Notice that's not really due to the green bars or the price falling, but rather you can see the blue quality line that's a little bit overlapped by the red line and also by marked sanitation, but it's leveled out right there, right under the bottom of the circle. The par and the quality line made a jump, which tells me that more than likely, it's not an absolute certainty, but more than likely, much of the increase in par is the result of an improvement in expectations for the company, which is reflected in the quality rating. And in NetEase's case, that is, in fact, what occurred. So next slide. Let's talk a little bit about what NetEase does. Here's from their third quarter earnings release presentation, which you can access on their website, and which I'm sorry I did not click here for you. It is not NetEase.com. It has a number in it. I can't recall it off the top of my head, but you can Google NetEase and find it. It's, as they say, a leading China-based internet company. Their main business currently, at least revenue generator, is online games. They are the leading, or one of the leading online game companies in China. They are the leading provider of free internet email and blogging services, which they seek to leverage into bringing you into online games, as well as seek to leverage for advertisers. Some of their specific areas that they are business in, they conduct business, online games, as you can see, internet portal. They are an advertising generated, or much of their revenue is generated by advertising. We'll see that in a couple of moments. Next slide. Email and blog, as I mentioned, they're the largest provider of these services in China. They also do have a search engine that is young, but is attempting to compete against Baidu and Google as well. And then they have another division, which is their smallest, which is wireless value-added services. As you can see, just services to enable users to get their news and so forth on mobile phones rather than computers. Next slide. They report their revenues in 3 basic segments. Online game services, that's 87% of 2010 revenues, which is the last available full year. Morningstar projects growth in the high teens for online game services over the next 5 years. Advertising services is about 11% of their revenues, and they're seeking to build more of that. Morningstar projects growth in the low 20s there. And then you can see the wireless services right now is only about 2% of the revenues. Next slide. Here's the last slide from the presentation I talked about. and they called it, as you can see, the key takeaways. And again, they're just mentioning the first 3 items talk about their online gaming. Fantasy Westward Journey is one of the most popular games. They are unlike any of their competitors in China in that they have a very strong in-house development capability. They've also partnered with American company Blizzard Entertainment for Warcraft, StarCraft, and their follow-on games that I think Warcraft is in the 3rd or 4th version, and they have all been very successful for NetEase. Again, back to their portal and email base, they are seeking to leverage for advertisement, and they have a very strong balance sheet with 0 debt. So I'd certainly like to see that, particularly in an internet type of company. Let's look at my valuation. Remember, it was in the yellow with quite high par, around 27%. These these projections, primarily in the sales growth rate, is somewhat more conservative than the default manifest picks. You see a 17.7% annual rate. I got that simply based on the Morningstar projections that we referred to earlier. I took 17% growth for the 87% online game, and then weighted about 22% growth by the 11%, or actually by the 13% value-added services and advertising services. That comes out to 17.7. Net margin, I picked just a little under the current. Margin actually went up in 2011. You can see that reflected in the 46.5 there on the left-hand column of the Eagle. It had been running about 43%, but they are paying higher royalties to Blizzard and Activision. So most analysts are projecting margins to shrink a little bit, and I chose to lower my margin a little bit based on that. Left shares roughly the same, which then gave me a 7.91 per share 5 years.
Mark, we're having some technical issues with Si.
Yep, he's dropping out a little bit on it. He's almost done though. So go ahead, Si.
E of 13. Yeah.
Si,
I think I'm breaking up it.
Yeah, we were having some technical issues, right, Si? Continue.
All right. Forecast about the same 13. That's a little bit of a wild card there. Certainly a company growing at 17% or greater could merit a higher forecast, but again, I think we get a Chinese discount there. So if ever NetEase, NetEase entered into the blue chip of Chinese companies range, or a more acceptable range, you might see the PE forecast being higher than that, or actual PE being higher than that. All that leads to a 15.5, which is significantly lower than the default manifest, but still very healthy. And like Ken, I liked increasing the sales growth rate. And I'll just mention it had an excellent quality of 90, which in large part was based on both its growth and relative growth and relative margin. I recalculated the quality based on my lower growth rate and lower margin rates, and it still comes out to 84. So it's still a very high, excellent quality company, even if you reduce the projections a little bit.
Yeah, and then
NetEase, my pick.
Okay, well, thanks, Si. And in fact, in the update batch that I'm working on right now, for whatever reason, it did show up in the batch, and that rate did actually move down to about 20% with a quality rating of about 82 or 83. But it's still, just as you show here, it's still in the teens, quite attractive.
Yeah, let me add just something. One of the model clubs that I belong to actually owns this stock and has owned it for maybe about two and a half years now. It drives us crazy because it only reports twice a year, and it's not real careful about dates and times. So the report that comes out only twice a year many times will be late, and they'll kind of play a game of chicken with the listing agencies and with the exchanges and everything else. But eventually the report does come out, and eventually it's there for you to analyze and do what you need to do with it. Just be aware that you're only seeing 2 of those a year, not the normal 4.
Probably become the next short-selling target for our favorite companies. Amazing. Okay, well, thank you, Si. So with that, let's go ahead and turn to Ken. As he said, he ended up with Quality Systems. So you need me to switch control to you, Ken?
Yeah, please.
Okay.
Okay. A lot of you ask me what's the process I use when I'm buying a small stock, and then what's the process I use when I'm actually looking at adding to a small stock. So I thought I'd go through a little bit of what I actually do, because Quality Systems is a stock that I actually own and have owned for a long, long while. I discovered it maybe as long as 5 or 6 years ago and have held it ever since and have been quite pleased. But what I'll do when I'm ready to add to a stock like that, and when Manifest is giving me the heads up that it might be in a place that I want to add, when my SSG is confirming what the Manifest site is telling me, I'll go to the website of the company under investors, and I won't look for press releases. I'll look for events and presentations. And here I found it listed exactly the way I would expect to see it. And when I pull it up, I'll notice that there's an event that happened really a short time ago. It was on February 15th, 2012, and I can listen to it. I can actually view the presentation if I choose to. So here I am clicking View the Presentation. Since I'm familiar with the company, I'm also familiar with a lot of the vocabulary the company chooses to use. So I can go through its own slides, pulling out what's important to me and seeing if anything major has changed in the company. For example, I can read a company overview, and I've already known that QSII, Quality Systems Incorporated, is essentially dealing with electronic health records, EHR further on in the presentation, but they're also moving into revenue cycle management applications. And that's quite a mouthful unless you research a little bit and figure out what the heck that means. Basically what that means is finding out if a patient has dual coverage from the insurance companies, and then trying to figure out which insurance pays what and get those revenues recognized and get them flowing in to the company, rather than having them in a stalemate between the 2 insurance companies. Many Medicare people, for example, will carry Medicare insurance, and then they'll also carry insurance that will back Medicare up. And getting them to talk sometimes is not the easiest process in the whole world. Quality Systems is developing some tools to help practices do that. Here's a timeline history that's interesting if you are looking at the company for the first time. And here's some things that the company considers as market drivers. I really like this second one from the bottom here. When I first started looking at this company, all of the stuff that I was reading was talking about if we succeed in moving to electronic medical records. And what's happened now after 5 or 6 years of a lot of talk about the whole process, we've moved from the word if to the word when in a lot of the things that are going through the news and going through the industries and everything. And that's really driving the market forward. It's seen as something that's inevitable. Here's the divisions that QSI is divided up into, and notice that QSI itself is a relatively minor part of the entire company. The company does most of its business branded as Next Gen. So if you're seeing Next Gen in your physician's offices or in your some of your, well, I messed that up pretty good, didn't I? If you're seeing Next Gen in your physician's offices or your ambulatory practices or things like that, that's really quality systems. You can read all these things. There's a lot of interest there, but I moved to this right here because my interest was, am I going to have to rethink my growth rates going forward for sales and then ultimately for earnings per share? And I like to see some graph that's similar to this that characterizes where the company feels high growth is going to come from. And this graph is a great one for quality systems because it shows me that the very places where the company is underrepresented are also the places where it has the most potential to exhibit some high growth. So the company is really pressing in these areas right here. This is electronic health records for physicians' offices. These are the same thing for clinical and dental offices. And we're looking at really very, very decent growth. This is this cycle management, this idea of trying to coordinate the insurance companies and all the other stuff that goes into that idea. So I can continue to look at the graphs and analyze them and read them, but eventually that takes me back to a stock selection guide. I do like to include the next couple of years of growth just to kind of make sure that the trend is continuing. I see 20% in the most recent quarter, which means that most of these quarters here, since that's pretty straight, are probably at least 20%, maybe a little bit better. And you know, I've decided that my 17 and 18, which I've had on this company now since I did a national presentation on this back about 3.5 years ago, I've decided those numbers still hold for my purposes. So I turn this over. I do notice that there's a little bit of downward drift in the most recent pre-tax profit compared to the 5-year average, but I do notice that coming out of the recession we seem to be moving back upward again. I'll watch this kind of closely, although I do know that this margin is first or second in the industry that quality systems in. Same thing's true on ROE. It seems to have bottomed out in 2009 and moving back in a positive direction. And again, I'll watch this closely moving forward. The company has lots of cash, over $120 million in cash, 0 debt, and what I really like is that I'm getting a small, fast-growing company, and I'm getting it along with a dividend. Here's where a dividend just speaks to me. It just sings in my ears because I'm buying exactly the kind of company that I want, a small, fast grower, and they're paying me to take the risk on top of that. And it's a pretty decent dividend if you take a look at it. I've estimated PEs for purposes of zoning at about the 5-year averages. You know, this top one might be a little bit aggressive for some of you in the audience, so I would urge you to do your own SSG and decide for yourself where you think it might be 5 years from now. I'm getting a 17% possible return after deciding payout ratios around 60%. I think Manifest is just under 16%. So I'm in the same ballpark. I'm happy, and I'm happy to place another $1,000 on QSII going forward.
Well, thanks, Ken. Let me go ahead and switch the control back to me then. You're done, right? And Ken, isn't that an example of a company you found on one of the small company lists a few years ago?
I originally found this company on the Forbes list of at that time I think it was the 200 fastest growing small companies. I think it's gone down to 100 now.
That's
That's where I found it, and it was quite a number of years ago. In fact, I was busy recommending this company to you and Don Danko and Jim Sobel when we had Christmas dinner at Kurt's house, and that had to be at least 5, maybe 6 years ago.
Okay, gotcha. All right, let's go ahead and move on to our reigning individual champion, Nick Stratigos of the Pittsburgh Penguin area. And I do think I want to point out a potential conspiracy here, because Ken has been talking about Route 21 for a little while now, so I think there may be a little bit of a conspiracy action going on here. Go ahead.
Well,
Nick.
I'll be the first to admit that there's absolutely no conspiracy, because Ken and I had no discussions prior to tonight about this company.
Or so he says.
Well, I'm going to give you a little background that's not on my slides, but I went a little different way. I mean, being a one-time invited guest here, I didn't go to the lists and charts and everything of what's already owned. I decided to go and search for something new to study, something that maybe I hadn't even studied before either. So I went to one of my favorite sites that I'm using now, learning to use as a screener, called FinViz.
Mm-hmm.
And FinViz is a site where it's kind of replaced the MSN searches that I used to do in the older days. It allows me to create and save searches. And so what I did was I went and did a small company search, fed in some of the traditional better investing principles of 5-year growth rates, 15% or more, especially in the small company area, history of 15% or more, both sales and earnings. Came up with a list, and I went down that list, and I saw a company whose name I recognized because I drive by their headquarters just about every day. And I said, boy, this could be an interesting one to do it, because it's got a little Pittsburgh connection too.
Wow.
So I jumped into it and said, I'll take a look at Route 21, and I started really from scratch on this study. What I did is what I do typically with everything is I find as much research as I can. I pull a value line. Morningstar has it. They don't follow it very closely. They don't have any recommendations for it. S&P has a sheet on it, but they also don't have any much information. When you pull up the Yahoo Finance, you see that they're followed by the bifocals aren't working tonight. Right now it's followed by about 8 analysts in the Yahoo area. So I thought, this could be a good company to look at. So when I started reading about it, maybe the first thing to do, Mark, is move down the slide for me, and we'll talk a little bit about the company itself. I started to learn about the company. I found out that it was founded in 1976. It went public in November of 2009, so it's only been public for a very short time. So that's one of the pieces that in traditional better investing studies you don't really follow through much on, because it's got such a short history. You try to get 5 or more years of history to be able to project to the future. But because this company's been around for a long time, I decided to go ahead with it anyway. So what do? They're a specialty retailer. They do private label apparel and accessories for boys and girls, 11 to 17. And if you were here earlier, you understand that I have 3 children in that 11 to 17. So this is right close to home too. And as a matter of fact, while I was studying the company, I was also doing an informal survey of my kids and cousins and aunts and uncles and everybody else to find out what they thought about it. And it turns out that they really like it, particularly because of the apparel that they sell is not going to be in the same competitive markets as the Abercrombies or the American Eagles, but they're more in line with the value places like a Walmart or a Target or something like that, and they're actually pretty good quality stuff. It also gives them a chance to not be in a department type store and still receive a good value. Another thing that they do is that they don't own any real estate. They focus on leasing in strip centers, regional malls, and outlet centers. As a matter of fact, there's an outlet mall near where I live. It's in Grove City, Pennsylvania, and they have an outlet there. And they primarily focus on small and middle market communities. So that's where they're at. So if you could flip over to the next one, Mark. What are they trying to do to grow? Well, right now they have about 725 or so stores now. The number I have there is from their 2010 annual report. So it's about 725 to 750 stores now. They're in 46 of the 50 states. They want to grow their store base to 1,000, And even if you read the value line, they want to try to double that 725 by 2018. So they're looking at 1,500 stores in about 6 years. They're also looking to expand store square footage. They have a new concept that they're using. It's called Rue 21, etc. And what that is, it's still the clothing store, but they're offering a separate in-store experience for girls' jewelry and accessories. It kind of makes them feel like a princess, I guess. So they're trying to build some brand commitment and continuation so people are really stay affiliated with the Rue 21 brand. And they also need to increase their brand awareness and penetration. And what's not on this slide, and one of the things that I'm reading about too, is they're doing it right now without any internet presence. And that's another growth strategy that they're starting to look at, is developing an online website for people to be able to purchase online. So they're doing it really the old-fashioned way, if you will, with just bricks and mortar at this point. And to keep with the first three too, it's not on here yet either, but this company also has no debt. So we have another strong company. They have strong cash positions, and they have no debt. To take a look at some of the inside, you can see we like to see the pre-tax profit margin increasing. In this one, we have some data from before they were public in 07 and 08, and you can see that pre-tax profit margin is heading in absolutely the right direction. I'm not sure that there's going to be a whole lot more room for that to grow, and I'd probably put that into some of my thinking too when I pick the rates on the next couple slides. As we've looked at before too, you want to make sure that there's no crashing going on in the analyst size, and even though it's only followed by 6 or 8 analysts, you can see that they've been pretty consistent in terms of what their growth rates are going to be. There's really not any significant up, but more importantly, there's no significant downturns in any of those numbers. So if you go ahead and move on, take a look at my analysis on the Eagle. I've adjusted some of the rates, and when I looked at the annual growth rates for the sales, I took a look at what they were talking about at both Value Line and Yahoo. And at Value Line, they're talking about growth rates for the 4 to 6 years out in around the 14 to 15% range. When I looked at Yahoo, they're looking at 1-year sales growth rates near 18, and 1 and 5 year earnings per share estimates between 16 and 18. And the same is true on the Finviz site, where they're looking at growth rates for between 15 and 18%. So I tempered it back to 16%. So I figured that if I could be a little bit conservative and be on the low end of their expectations, we have a much better chance for success. So that gives us the 5-year forecast out there. Their net margins are about 4.8. I left them pretty consistent. I just rounded up, not knowing any better. I just rounded up to 5. They have about 24.7 shares outstanding now. I increased that a bit because Value Line also seemed to have increased it. They're looking at actually I picked their number right off. It's 26 million shares outstanding. So that gives us an earnings per share growth rate about 15.6. I'm pretty comfortable with that when Yahoo and Finviz are telling me 15.7. So we have a 306. The PE ratio forecast, I went again there. I went back to the Value Line, looked at their PEs, and their forecasted PE, oh, come on, glasses work. Their forecasted PE is actually 22. Oh, thanks, you beat me to it, Mark. And so I picked 20 again just to be a bit conservative. So that gives us a price of about $61 and a par of about 18.1%. I'm very happy with that. It's a little bit above, and it's probably getting a little closer as the overall my par is inching up. That's getting a little closer to being within the green range as opposed to the yellow range.
Excellent.
And the last slide that I put on there, excuse me. I'm very new at the stock charts, but I wanted to take a look at it and see if I could figure out anything interesting or exciting. And I guess the thing I find here is that the stock has had a pretty significant run-up this year from 20 to 26 bucks. And you can see there where the RSI shows you the 30, it's near the 30. It never really gets below the 30 or above the 70, but it touches both lines along that time frame. So that can give you some indication right now that maybe it's been in a little bit of an oversold position and now it's coming back down. And while this company has a decent par, there may be an opportunity to wait a little bit really to buy this stock for yourself in your portfolio. Obviously, recommending it tonight, we're going to put it into the roundtable portfolio, but there could be some opportunities to maybe wait for this to come down a little bit. And I believe this was, let me see, the date there was from Friday. I think today the stock was up just 1 penny, so it's still pretty much reasonable with what happened today. So that's my story. Hopefully I'll do okay for the nights going forward, and we'll see how it goes.
I'll trade you a few shares of Research in Motion for it.
I don't think so.
Good stuff. Well, thanks, Nick. I didn't realize that was another local company for you. That's
Oh yeah. Oh yeah, I do literally drive right by, and it's kind of interesting too because in the industrial park where they're at, American Eagle has a pretty significant presence also.
Okay.
Because their corporate offices are here in Pittsburgh too. They're actually down on the south side of Pittsburgh, where I live north of the city. But American Eagle has a pretty significant presence in that same industrial park that I drive through every day.
Should be a fun one to watch.
I only have one granddaughter, Nick, in that that demographic, but she shook my faith in this company when she told me that she had gone back to liking Aeropostale better than Route 21.
Uh-oh.
Well, that means two things. One, it's not good for the stock, but it's also not good for the pocketbook.
So. You got that right. Okay.
All right. Thanks, guys. All right. I thought I would come back and wrap things up with a stock pick. I continue to keep trying. Eventually, maybe I'll get one right. What I thought I would demonstrate for the group tonight is one of my favorite screens, and it's a screen that you can run using the stock search at Manifest. And I'm only searching on one number here. I'm screening on one number, and it's the Manifest rank. Again, the Manifest rank is the combination of, it's kind of a weighted composite of projected annual return and quality. So what we're out there shopping for is literally companies in the top half of the top percentile, shopping for some companies of interest, and you'll see many common names that you've heard kicked around here tonight make this list also. Probably the only reason I didn't add to Cognizant is because QSII has picked it a couple times in the last couple of months. These are both good companies. They can be direct competitors. You also heard Ken mention that the software consulting industry group has not really has not participated quite so much in this stock market advance. So if the fundamentals of these companies are strong, chances are days ahead could look pretty good for the companies. Here's a look at Infosys Technologies' business model analysis. Again, the visual analysis of how the sales and earnings have performed for the company last several years, including a couple years of estimates. One of those nice stories. A little bit of recession impact, as you can see by the gray shaded area, but a very strong picture going forward. These guys are in the management consulting and business software business environment. And again, just a real strong grower, certainly in the low teens. And you can see that the projected low return forecast at Value Line is in the 15% range. So again, that's a pretty healthy advantage or performance advantage over the average stock out there these days. You know, much like Nick was looking at a few minutes ago, this is a little bit longer term look. I tend to use the same type of information only in a longer term perspective. This is a 5-year look at Infosys Technology, and you can see that towards the end, last autumn, we did have one of those moments where the indicators were that it was fairly significantly perhaps oversold, and that's where we saw these numbers down around the 45 range. So that's the last time it was really oversold pretty heavily. It's kind of in the middle range now. Nothing to get too concerned about. And again, just as reinforcement, anytime we see these overbought conditions like I'm highlighting here, again, this is a stock with a fair amount of momentum, so we wouldn't we wouldn't break into the hives whenever we see that. But having said that, we're not the least bit surprised to see either a flat spot or a decline following one of those moments. And we don't have one of those right now, but again, as Nick was saying, just something to keep in mind that if the rhinos all hate your stock, it's probably not going anywhere in stock price for a while. A company like this, the tendency is for it to just kind of get stuck for a while. You see another buying opportunity back here. So we do try to watch for those type of buying opportunities at a relative strength index according to stockcharts.com. This is a free site. Here's the website over here. A relative strength index down in the neighborhood of 30, especially if it's showing signs of strengthening fundamentally. Here's a look at the Chronicle, again, based on the value line forecasts for the company, and we like to do this every once in a while just to take a look at how the company has behaved price-wise versus forecast-wise. And you can see that, for instance, back in that spot where we said it was really on sale in the preceding slide, back in this time frame right here, here's what it looked like on our stock studies. It was actually up in, we featured it as a monthly stock to study at Manifest, had relatively high projected returns back in that time frame, and you can see that that certainly has materialized quite well. The recent downdraft in price, again, probably concerns over the economic pressures of the world recession, the problems in Europe, a variety of other things. There are some business dynamics in place where it's a very competitive environment. Even some government pressures which could lead to some reductions in margins. That accounts for some of this here. The price has sagged back down, and the projected return has actually climbed back to where it was 2 years ago. So I find that to be very attractive. And again, I would consider Cognizant to be pretty attractive also. So I think we'll just leave it at that. We're coming up on 9:30. I'm going to recommend that we go ahead and add Infosys technology to the portfolio. And again, one of the other things I like, you've heard it 3 times, I'll make it a foursome. This company has no debt either. So we have 4 companies tonight with no debt. That's something that doesn't happen very often.
It's interesting, Mark, that on that list of 14 stocks that you brought up on that screen, that there's a third competitor of the 2 top ones. Down the list a little bit is Syntel. That's a Michigan company that's a direct competitor of Cognizant and Infosys as well.
And that's a good study also. I'd recommend that as a study.
Absolutely.
And then, right below that, again, if people are looking for ideas for stocks to study, that AeroVironment is a company that appeared on that heavy Hogs list. It is a company that is involved in the manufacture of drones for the military and a variety of other equipment and defense system type stuff. But it's a company I had not heard of until I saw it being selected by a number of the participants in this year's Groundhog contest. And then, of course, for the shoppers and the ladies in the room, this one is a brand new addition to Value Line, and it's another company I'm going to have to confess that I don't understand, but many of you out there do. And it's reaching a point in its life cycle where it's becoming post-emergent. Probably time to begin thinking about if this company is going to be very successful down the road. It's worth a study, at least putting it on your radar screen. So with that, I think we'll open it up for questions. I saw that Ann Manning had a comment about size selection tonight. Can we unmute Ann, Ken? I think she's out there.
Sure we can, because she also is asking a question about TJX. If you give me just a moment to redo all my windows so I can see the one I want to use. Here we go. Okay, Ann is unmuted. Go ahead, Ann.
Thanks. Great job tonight, guys. Enjoy the presentation. I did ask if TJX had split, what it looks like to me. And also, I didn't know if Kim was here tonight, if she might give us some insight of why Deere went, their par went way back up again, or maybe somebody else knows.
I hadn't noticed that.
Well, because last month it was down pretty low. Let's see, it was down to 4.9, and now it's back up to 13.3. So why would that happen?
Well, during their last update, they probably did pick up some fundamentals. They probably did have. That was in last week's update, and I'm pretty sure that one of the things that we started doing is identifying companies that have pretty big swings in expectations, and the way that we notice that is by the change in the value line low price forecast. Let me go ahead and pull up value line. I'm pretty sure Deere was one of those. What you're probably seeing, Ann, is the result of this price forecast at Deere. I'm pretty sure went from somewhere in the $90 to $100 range up to $120. And the only way that can happen, well, one of the ways that can happen is for probably a strengthening of either profitability or growth forecasts at the company. Could be PE also.
So that would cause a 10% rise in par?
I don't know that it was 10%.
I mean, not 10%, 10 points.
Uh-huh. It could. It very well could. I'd have to go back and look. Why don't you send me a note or make a post in the forum, and we can do a before and after comparison.
Okay.
Mark, if you switch screens to me, I'll show folks how to answer Ann's other question, okay?
Okay. Oops, sorry. Also got to figure out what window I'm trying to grab.
Just don't fall out of Windows.
There you go, Ken.
Okay, what I'm showing on my screen here is just the plain old Yahoo Finance site. And folks, if you go to historical prices, Ann wants to know, did TJX recently split? Once you're at historical prices, just scroll down a little bit, and if there's been a recent split, it'll appear right on that list. So Ann, here we are right here on February 3rd. There was a 2-for-1 stock split in TJX.
So what does that do y'all think, with it being down to 4.6? Do you still want to keep that in the round table?
Well, first of all, my question would be, did Mark split it in his database?
Yes.
We'd have to make sure he did that. If the answer is yes, then I've answered this question before, Ann, and I'll answer it again. As long as this is my opinion now, as long as my total portfolio is in pretty good shape, I'm not about to kick a winner out that has some momentum going for it, even though it has a fairly low suggested PAR going forward. Now, if that would move into negative territory, I might re-examine the whole thing and rethink it. But for the moment, the entire portfolio is in the sweet spot, and I'm perfectly content to have that TGX sitting where it's sitting, because I do know that it's carrying some momentum, and that helps to. It's not scientific, Ann. It's not. I'm not appealing to any fundamentals, but it does seem to work for me.
Yeah, it has gone up since the split. So.
Yeah, it's still up on an annualized basis. Post split, it's up 47%. So it's clearly it's the best selection that we've made in the roundtable portfolio.
I told Mark before we started this evening, I only wish that the next month I would have chosen it again. That's all. So, Mark, we have a question from Don, and Don wants to know, what do you think of carboceramics, CRR? He's seen it on a few of the screens this evening, and it interests him. Any ideas about that company?
Okay, well, that one is showing up on a few groundhog selection screens, also part of the contest. In fact, you want to switch the control back to me, Ken, and I'll.
It's coming. Yep, it's coming. There you go.
All right. And what we'll do is just take a quick look at what Value Line thinks, first of all. And for carboceramics, this kind of explains for me why some of the groundhog participants are interested, and it has to do with this 19% number right here. For people who are not familiar with it, this is an oil and gas field services company that they provide hardware and equipment to companies that are involved in fracking and enhanced oil recovery and enhanced gas recovery. So that's where they put some of their ceramics to work, and that's certainly an area of potential.
Also in some of the horizontal drilling, Mark.
Right. So they're basically trying to get more out of the fields that are in play. I'll let people take a look at some of the text here as we're talking about it. So I mean it's a good story. I like the projected return. I like the fact that it's got a very high quality rating. It's not located in Pittsburgh or Nick would own it. So a lot of good stuff working in favor of this company. It's definitely a good study, and like I say, some of our colleagues, like-minded investors, are pretty high on it.
Mark, I think we've gotten very quickly to the end of our question list this evening.
Okay. Yeah, we're up at...
You're getting a kudos from Butch for adding KOG to the database.
Yeah, you're welcome, Butch, and that's actually propelling the current leader of this year's groundhog to the top of the list. So it's
and for those of you that are beginning to play with options, or for those of you that already play with options, Dick is indicating that this is an excellent opportunity to sell an option on carboceramics right now. So we're not going to get into that this evening, but he's suggesting that if that interests you, you might want to take a look at it. And other than that, Mark, we are clear.
Okay, very good. Yeah, that's something we should take a look at in the near future. Taking a look at the options type opportunities. And I just wanted to show what, even with the split involved, how strong the picture does look for TJX. And this is an example of a company we might have some discussions about, maybe even some type of a programmed approach to selling it, especially if it stays down at the lowest par in the portfolio. But notice that it is up at an extremely strong burst of momentum, and but the flip side of that is that it has not shown, despite the fact that it's in the apparel retail type area, any tendency to take any sharp nosedives, other than what happened obviously back during that the Great Recession back in late 2008, early 2009. So,
Dick, I'm unmuting you. You said you had a question on QSII. Oh, he's going to type it now. Okay, the question says that his SSG shows 16.3 ROE for 2010. Any ideas why it would be so different from Ken's data? And let me pull up my SSG again just to look. And I have no idea why it would be so different.
I'm just looking at it on Value Line.
Look like it's well above 16.
Yeah, I'm looking and I'm refreshing my data just in case I have something old, but I thought I had the most recent data there, and nothing changed. So, Dick, I don't have any idea why my data would look different than yours. I'm using the data feed from Better Investing, and I'm showing a return on equity of 32.5 in 2010. If you'll look, and I'm going to go to the front now again, if you'll look, QSII has a 2011 fiscal year that will not end yet until the end of March 2012. So our most recent fiscal year for QSII is 2010, but I can't give you an answer on why the data is so different. I wish I could.
Dick says he just updated, so.
And now it matches. Okay. You gotta press that update button every now and then. Okay. All right. And Marie Mark would like to know if you could just very, very quickly tell her the 3 things that are necessary for a triple play.
Oh, sure. It's a good topic, especially as we get a little more careful. Here's as the stock market surges ahead, they can be a little bit harder to find, but they can be quite protective. What you're basically looking at, and let's use this one as an example. We've got quality systems up on the screen. Anytime you're looking for a triple play candidate, I do like to use Value Line as a place to do it. First of all, you're looking for an elevated return or a depressed stock price. That's the first condition. And in this case, we see a 17% low total return forecast for quality systems. And you can actually see that there is a little bit of a depression here, probably why it's caught Ken's attention, dropping down from a high somewhere around 50 down into that 36 range. So it is a depressed stock price with a projected return somewhere in the high teens. I believe Ken said he had like a 16% projected return for it. The second thing that you're looking for is a company that has the opportunity or potential to improve its profitability. And what you're looking for there is a case where current profitability, in this case measured by net margin, that 17 is actually slated to potentially improve up to 22. So that's the second condition. Did you have a comment, Ken?
Well, no, except I just like to note always that Value Line gets a little crazy sometimes, and that this company has never hit 22 in the last 10 years. But even if it doesn't go to 22, if it only goes to 19 or 20, it still has that ability to grow, and that's what I'm looking for there.
It's a good point. In fact, I have a picture from Solomon this morning working on it that shows exactly how much caffeine the Value Line analysts have apparently been drinking. I may post that in the forum within the next day or so. Okay, and then the other thing that you're looking for is an opportunity for the company to trade at a higher PE ratio in the future. The current PE ratio of quality systems is fairly healthy, 24-ish, and in this case, they believe that it's possible for the company to trade in the future at, again, a 27. Again, same comment as Ken just made. That's not a huge positive potential for PE expansion, but that is the third condition, and at least it's not a situation with likely contraction, at least according to this analysis.
And we should make the point that the arithmetic of PE expansion happens pretty quickly. You don't have to expand PEs more than 1 or 2 or 3 points a lot of times to find yourself sitting on a windfall of increased stock price when it's all said and done.
So those are the 3 conditions. You want a stock with a high return forecast, the opportunity for better profitability in the future, and for a higher valuation in the future. Anything else tonight, Ken?
This time I think we've cleared it for good. I'd like to thank everybody for their kind words. This one did feel real good tonight, and we hope you felt the same way. I think that we've actually set a date. No, I'm going to take that back. We have not set a date for next month yet, but if you are with us and are not receiving an email from my wife that's reminding you about the roundtable, if you'll send an email to, do you have our email addresses on the screen there, Mark, anywhere? There we go. So if you'll send me an email address, I'll make sure you go on our list, and then you'll get a reminder once a month about when the roundtable is going to be held. We deliberately move it all around the calendar so that if you can't make it on a Tuesday, you might be able to make it some months on a Monday or a Thursday.